name is Jason Jackson. I'm the Chief Investment Officer of IBS Investment Bank. Like the other guys, I do a lot, but what I'm going to focus on today is our small balance investment real estate fund. It's a $225 million open-ended fund, and we're focused on $500,000 up to about $7 million through our small balance fund. Our key difference is that we're in between bridge lenders and the depository folks. So we can get rates in the 5s, and we go up north from there. We're not looking at tax returns. We're looking at the potential of the project, gross potential rents, and we're looking at all asset classes except for hotels through that fund. Also, I'm the senior member at IBS Real Estate Investment Company, which is an owner-operator. Like many of you that are owner-operators, we're in that space as well, and we are providing limited partnership equity. Right now, I would say if I'm looking at limited partnership equity, it's going to be predominantly in South Florida, possibly the remainder of the state, and our focus in doing that is to bypass the debt. But that's about it. And again, I want to thank you, and we're going to jump right into to our first topic, I suppose, and the evolution of lender objectives within CRE finance. What exactly has changed, Ken, over the last 24 months? What has your bank done to, what's changed in terms of your underwriting guidelines, the scope over the last 24 months that you think is important for everyone to know?
Sure, thanks, Jason. I think, as I think about that question, I think folks would be surprised to hear that my perspective is our underwriting standards really haven't changed much at all in the last 24 months. I think at PNC we pride ourselves on consistency. We have a very good, solid group of clients we work with through various parts of the cycle, and cycles for that matter. And certainly there's a recognition that the market's changing and we're later in the cycle than we were 24 months ago, needless to say. But if you were to look at our typical underwriting metrics, whether that were LTC, LTV, amount of payment guarantees, we also do non-recourse, very little has changed. I think we've tightened our hotel hospitality lending a bit on the construction side and on the perm side for that matter. But otherwise, our underwriting standards have held relatively consistent. There's just more acknowledgement that the market is tighter and deals are more difficult to be done.
Okay, so not much has changed in terms of just trying to make sure that you're on the right side of the market. It's great. Mark, in the last 24 months, what's changed over there at Hunt?
Well, on our end, because we are also on the equity side and are an equity player on the LP side behind developers, what we've seen is on the construction lending side, and I think that's a question that was raised earlier and should be addressed. What we've seen is the senior traditional lenders have lowered their LTV range on the non-recourse financing. So what you're seeing a lot more activity in is in the pref equity space. And also, folks like ourselves are raising funds to do a blend of senior and pref to get higher in the capital stack. And again, that's a function of the regulators kind of telling the banks that they have too much multifamily exposure in certain markets and in new construction. And so for us, on the agency side, that continues to go. Everyone knows the stats, they've seen them. But what we're seeing is more activity and a lot more guys being more receptive to the FHA 221D4. Sellers are being more receptive to timing and understanding what it takes to capitalize a deal, the cost of equity, and debt, and putting that together has become, in my opinion, the most interesting aspect of the market in the last 24 months.
All right, perfect, and thank you for that, Mark, and I agree with you that in terms of leverage, it's just a matter of appropriating the proper capital stack that not just can get through regulatory function, but also that the project can sustain. You do too much pref equity or mezz, that can get pretty expensive, so you don't want the project to fail before it starts. What's changed over there, Jesse, in the last 24 months at Center State?
I'd say really that there's nothing changed on the credit underwriting standpoint, but more on the regulatory standpoint. You know, now we seem to be looking at more files based on what the regulators will do when they come in and do our annual review. And that goes back to the function of just the increased regulation and the types of things that are going on with different banks in the market, where banks tend to be taking more risk than what they were before in order just to secure deals. And we've just made a conscious effort that we're not going to go down that road, because at the end of the day, we've got to report our shareholders and to the regulators, and you know, it just doesn't make sense to us to stretch our limits or to change our underwriting guidelines, because we've always been a conservative lender.
Perfect. And since we had a question about regulatory impositions, what could you give them an idea of specific regulatory changes that would be impacting the borrower the most? Like, what is there anything that stands out from a regulatory standpoint that you would say has changed that you guys have to comply with that ultimately immediately impacts the borrower?
I think it's just more a question of that they're really doing a deeper dive on all of the files now, because of the increase in values and the lower cap rates. So it's really not any specific change recently, it's just more along the lines of they're really doing a deeper dive than what they were before. And instead of them looking at a file and coming back with a couple of questions, they come back with 20 questions, even if you've done your due diligence on the client and the property and those types of things.
Perfect. And just so I can make sure that there's a clear understanding of what Jesse's saying, he's saying that when the regulators come into the bank, they want to make sure that the bank has done enhanced due diligence. So some of these things that may have gotten away before, they're not going to get away with now. So like them and like us at IBS Investment Bank, we see a lot of transactions that have a lot of they have legs, but unfortunately the sponsor didn't take the time to complete the package. So my advice, and I think collectively our advice would be, is particularly if you're going to go to a depository bank, there is great opportunities there, but if you need to hire an advisor or something like that, then to help you make sure that your package is actually cash flows, then do what you need to do, because if not, you're going to end up burning a bridge that probably could have worked for you. And it's not because the bank doesn't want to do the deal. The banks, they do want to do deals. They want to deploy capital. That's how they make their money. It's just that once it reaches a certain point, if there was a typo, it can cause you getting a deal. So right now in this climate, that it's very important that you make sure that your packages are well put together. Drew, what's changed? Oh, well, I mean, you guys, I know you've just gotten over there at the bank, but what would you say has changed in the last 24 months?
So I've only been at First Green Bank since June, but I'd say predating that, spent the last 10 years over at it's at CNL Bank. And I don't think from an underwriting standpoint, things have deviated. We haven't really, we've been pretty consistent on the underwriting piece. I think to speak to the regulatory aspect, and I know there was a question about how the regulatory piece kind of dovetails into what our capabilities are. And I mean, we're focused on in the banking business, we call the 100 bucket and the 300 bucket. The 100 bucket is 100% of the land and the construction on your balance sheet as a percentage of your capital, and the 300 is your CRE. And if you're hearing from your banks that their bucket is full, it's probably because of that 100 bucket anticipation of it filling up. So those are really the two kind of barometers that we're monitoring. We have projections on all of our construction fundings. So if we're going to start to pump the brakes, it's mainly because of those two key metrics internally.
Right, I think that's a very good point, Drew. Did anyone have any questions, or would you like further clarity on those two buckets that the banks need to fill, or because they're pretty good understanding? I don't think that's common knowledge, but do you want us to explain what that 100? Okay, so Drew, just explain again why that 100 bucket, why that can overflow and prevent opportunities in other areas for them.
I think Jesse can speak to this as well, but basically it's regulatory guidance, and I think that, I'm presuming even Carl is subject to it. We're FDIC regulated, and basically when they come and do the safety and soundness exam every year, they look at the concentration, so to speak. I can't tell you where they came up with 100 and 300, but this is guidance that goes back to, I think, even before the real estate crash. Although banks were pushing the envelope on the 300 bucket, they were going to 400. I think that it's the 300, for example, is not a hard stop, but if you go above 300 into the 350 territory, the regulators are looking for the banks to have more granular underwriting and portfolio management. So when your real estate lender starts asking you more questions, and then property type becomes, I think, a bigger topic. For example, hotels, just can't let that piece of the pie become disproportionate to the whole real estate bucket, so to speak. So, I don't know, Jesse, if you have any more.
And I think what it is too is that once you get, again, past that 300%, they start looking at what you're doing to change that mix. During the last recession, if you were over 300% in commercial investment real estate and had grown by 50% or more in the previous 4 years, you had a 70% chance more likelihood of failing as a bank. So that's what they're trying to watch now to make sure that banks aren't doing that again, because with rapid growth of some of the banks, especially in Florida, they're really taking a hard look at that. So.
Right, and so I think the takeaway from that is this, is one, as I mentioned before, the banks want to do the deals, but maybe they did too much on the hotel side already. Maybe they did too much land already. So it becomes a portfolio management, risk management, and regulatory compliance environment. So with that said, this is why conferences like these, and I thank the conferences for allowing us to be the first panel, because I want to make sure that you are well equipped to know what to take away from the entire conference. And I would say, do your best to ask this specific question. If you're speaking to a depository bank or even a fund manager like me, are you guys over concentrated in any area already? So I know you say you want to do the deal. I know you technically can turn the deal away. But are you guys over concentrated in an area? Then you know right away that although they would want to do the deal, they can't do the deal. Then you're not spinning your wheels. So I think, like us as principal operators, we've experienced adverse actions when applying for financing, not because they didn't want to do the deal, but they couldn't do the deal. So understanding each lender's landscape as to where they are, hopefully, and there's transparency, and they'll let you know where they are in terms of portfolio management and what they're looking at. So this is why, as I told the team up here, they of course, we all overlap in many areas, but all the difference could be in knowing who's still doing hotel, knowing who's not doing it. Although it looks like we do the same thing, the portfolios are very, very different. So if you can navigate through that, you could find yourself a deal. Let me ask, is there a single question? We're doing pretty good on time based on where is there any questions about any, let me specifically say, any questions about anything that was mentioned so far that we could elaborate on? Sir, in the back?
Yeah, I would ask Jesse, when you talk about the regulators asking that many more questions now, I'm not with a regulated institution, and I'm just kind of curious, are they second guessing your due diligence and the quality of it, or are they just second guessing the file? It's kind of foreign.
No, it's just that in the past, when they reviewed files, they took a certain stance on them, and now it seems that instead of having to go through one review on a file, they go through two, and we do a great job of documenting anything in the file. And these aren't loans with exceptions to policy or anything else, but it seems that now all the banks are having to underwrite as to what regulators will actually think, because it's not anything specific or anything different that we're doing or the banks. It's just that the regulators, it seems like they come in and they have to find some kind of a reason to almost justify their job, because at the end of the day, they've got to have a job, and they go through a lot of stuff that really 2 years ago or 3 years ago, it never even came up in issues. So it's not anything specific, I would say.
So job security is great for all of us, and I'd also say this: The unsaid thing is this, that we may be oversaturated in some areas, we may be a little bit puffed up in terms of values. So when you're lending 75% on an asset right now, it's quite possible in the next 2 years that you may be at 130% of that value. Now, that's not going to make for popular programming, but that's the reality of the matter, is that we're on the high side of the market. So I think in addition, the regulators understand that, they don't want to spook anyone, and maybe they don't understand it, but their bosses do. So what they're looking to do is make sure that there's proper portfolio management to the best of their ability. And so they are going to look to make sure that the portfolios are being managed. As Jesse mentioned, once it goes over certain percentages in certain areas, the rate of default substantially increases. So I think what they're trying to do is cap off the amount of loss that there will ultimately be by helping through the portfolio management area. All right, more specifically, and sorry, we're going to ask questions, and you'll be the first one once we get through this side. I'll make sure that I get you first. Who wins among sectors? Well, we're not really in competition. I just thought it was a great title. But I do want you to know exactly what industries, what sectors we're looking at, and so that you have an understanding of asset class. So Ken, in terms of asset class, what's your preferred? I know you're across the board on some things, but what's your preferred asset class right now?
Sure, and again, we are diversified with respect to the product type, but I think if you looked at PNC's capabilities, you would say multifamily between our balance sheet capabilities on the construction and permanent side, also value add rehab. We also have through PNC multifamily a large agency group and a large tax credit affordable housing group. So multifamily certainly we continue to be bullish on. We're aware of where we're at in the market today, but probably 35% of our volume has been multifamily.
Great, and I think that's important to know. If you are looking at a large multifamily development, it's something that Ken will look at. He's going to be relationship centric, and whereas, as I said, bullish. Other folks that have the capacity to do a $20 million, $30 million plus multifamily deal, there's not that many that do, not on the conventional side. Anyhow, not on the balance sheet side. Many of them have retracted, so I think if you have a project like that, I think that would be something to talk to PNC about. Mark, I know that you guys also are across the board on products and asset classes, but what would you say that you guys, what are the best in?
We're specific, and our focus is multifamily because because of the licenses that we hold, and we see a viable exit even with our balance sheet funds. So we do bridge balance sheet finance, we bridge to perm on the agency side, on the FHA HUD side. One thing to keep in mind, and I know everyone's concerned, and there's so much multifamily activity, and we've seen cycles similar to this. This one's had a longer run because of interest rates and cap rates. But Freddie and Fannie and FHA HUD have had the lowest loss ratio historically, and across the board from a lender perspective, CMBS, the traditional banks, and one of the things, as many of you have had an agency loan, is our structure and our underwriting, some of our reserve requirements, market specifics. For example, Houston right now is a pre-review market. We will not go to a certain leverage level with Freddie or Fannie in the Houston market. And so we believe at Hunt and like some of our competitors, that multifamily is one of the sacred cows, healthcare, education, and having a roof over your head. So we continue to be bullish, and the agencies are increasing their caps, and we're doing a lot more affordable product. But that is our core focus, multifamily.
Great, and what would you say the average loan size is, the typical loan size in your multifamily?
Our average loan size is anywhere between 10 and 30 million. We'll go up to 300-400 million. One of the interesting things that has come about in the last I'd say 2-3 years has been very aggressive, has been the small balance program. And it's an opportunity for, you know, your non-institutional, I'd say mom and pop owner to have access to, you know, Freddie, Fannie debt and be able to do a 20, 30 unit building, you know, for example, here in Miami, Little Havana, at 80% loan to value on a 10-year deal, 3 years, interest only. And I think that's been the biggest game changer, is the access for the small balance borrowers.
Perfect. Great. Jesse, what asset classes are you focused on? What's working the best for you? What do you think they should know?
I think with us, it's more retail and medical office. We do a lot of B and C retail centers all over Florida, some single asset or some single tenant buildings as well. So, I mean, we're competitive in that space. We do up to 10-year fixed rates on those types of things and 25-year amortization. So, if you're looking at those types of centers, we're definitely very competitive in that market. We do some industrial as well all over South Florida also.
Great. So retail and office, which I think by and large you'll find that most depository banks will verbally say they're interested in until your application's up. There is actually interest in that, so I think that's important to note. Typically on the retail side, you're going to be at a PNC level, you know, north of $15 million before, you know, they're going to look at lending in retail, most banks. So I think that's a pretty great advantage with Center State being able to look at that sub 15 million and look at retail. So I think that's pretty important. Drew, in terms of asset class?
We're not so much limited by asset class internally other than hotel hospitality. It's been more focused on loan size. We our kind of lending in-house limit is around 13 to 14 million, and we find that the debt piece under, say, 10 million is somewhat underserved. I think it's a function of the community banks have all disappeared, and for the borrowers out there that want the level of sophistication from their real estate lender a little bit greater than just the mom and pop community bank with $100 million in assets. You know, that's where we kind of fill that niche, is that middle piece that's, let's say, that is somewhat underserved, and it's the part that the Wells and the B of A's may not be interested in because they're focused on the larger transactions. So we find that there's plenty of opportunity with South Florida-based sponsors just focused, but like a lot of us up here, retail, office, industrial, some specialty use, real estate, medical, some general aviation, marine use, kind of runs the full gamut.
All right, perfect. And at IBS Investment Bank, we are also at industrial, office, retail. I would say that the biggest difference, aside from we're a little bit a bit of an uptick on the pricing, but we're closing inside of 30 days, sometimes 20 days. So if you have to move pretty quickly, we do that. We look at gross potential rents, as I mentioned before, and we're not looking at global cash flow. We're looking at asset-specific cash flow. And I think that's pretty important. If you're looking to avoid the whole tax return saga, that's kind of one of the areas that we're stronger in. In terms of hotel, it doesn't fit in our small balance program, but we have a conventional fund that we fund through. And so I'd say for hotels, we got to be north of 5 million. We're no longer constructing. We were constructing hotels under the, we were acting as a third-party lender on behalf of the 504 program, that first 50%, and which we still could do, but we're not as excited about, and we were selling our portion up to Morgan Stanley, so we're really not doing anything construction, but we do hotel as well, but we're more going to be on the refinance and recap. So recapitalization, I think that's something that's going to be different from us from a regulatory standpoint. But we're across the board on asset class, with the exception of construction. And as a principal IBS real estate investment company, as I mentioned, we're looking to deploy average limited partnership equity or any area of equity from our balance sheet, which is different from HUD. So the HUD is gonna arrange the equity participations through folks that are in their portfolio. This is our balance sheet. I'm the decision maker on that fund, and we're looking to place, I would say, between 1 to 3 million is typically our standard equity pool is what we're looking at. And we're right now focused predominantly on the South Florida region. If it's something compelling, we'll look at Georgia, North Carolina right now. Tier 2 markets, we're not looking at Tier 3 markets, and that's about that. And we had a gentleman in the back that had a question that I didn't get to. Sir, you still have that question? It was, I think it was next. We had a question that was in the back. Are you here now? Okay.
For those of you that are regulated banks, I'm on the board of Signature Bank in New York. I was curious as to how the regulators treat you, the federal regulators, in terms of, you talk about IOs, that's something that's a little bit, questionable now in terms of the way they proceed. Are you finding any sort of extra scrutiny or, sort of dictatorial approach in terms of underwriting or, concentration issues?
So who's your regulator? Are you OCC?
No, I'm on the board of Signature Bank in New York.
But who is your regulator? Is it the FDIC?
Yes.
Okay. So we're regulated by the FDIC, and I think that I don't know if I want to use the term more lax, but I think I have worked at OCC regulated banks, and they seem to be, I think, have a tighter leash. And we have a very good relationship with our regulators, I think, because when they gave us 6 months to focus in on something, we were very proactive, and we'll get it straightened out in 6 weeks. So far in the last safety and soundness exam, I understand that there wasn't any additional, I don't know what the word, pressure or scrutiny. I have heard from other banker friends that are with OCC regulated institutions that when it comes to the non-recourse or the limited recourse buckets, that is something that they are focused on. I'm not sure that they're necessarily preventing banks or telling banks to limit that exposure, but I understand that they are monitoring that. Ken, I don't know if you hear any of that.
Yeah, I would add that I think it's fairly bank specific. I think for those lending institutions that, behave the right way, for lack of a better term, historically through the cycles, perhaps is more recognition of the consistency of their approach. We have heard things, for instance, you alluded to some scrutiny over interest-only periods. I think it takes a little more effort to sit down and explain to folks that a 65% of cost loan with amortization is not necessarily superior to a 55% of cost loan interest only. So we've had to go through that exercise a few times, but certainly it's not feeling overly burdensome to us at PNC. I think we've had a very good relationship with the regulators historically. I think we're very comfortable with our real estate book today. But there's definitely more dialogue and more recognition of the growth of the real estate portfolio, but not anything that's overly burdensome.
Perfect. And thank you, guys. And do we have now any underwriting specific questions? So here's a great opportunity to speak with some of the decision makers that look at the transactions. Are there any underwriting specific transactional based questions that we have, sir?
So for the panel as a whole, when a loan goes through your process of origination, underwriting, goes through credit administration, where does it go from there? Does it go to a loan committee, or is it a series of 2 or 3 people who can sign off on the loan to get the loan amount you need to be able to close the transaction? And do any of you make loans on land? And if you do, what loan to value in today's markets? What type of land do you lend on?
Well, that was good. You took a great opportunity for that. That was like a 5-fold question. But let's and it's a very good question, by the way. So he is asking about our loan process and where does it go, who does it go to? Very, very good question, because you want to know that. If you speak to a representative, and they tell you that they sell you the dream, and then, you know, they have no authority, even in that region, to make that kind of sign off, then you'll find yourself in a tumultuous territory. So I am going to ask each one of you, but I'm just going to ask that you'll just be as concise as possible, please. And in terms of what that looks like. So in terms of IBS Investment Bank, all of our transactional, in terms of origination, that's going to go directly to me in the credit committee. We make decisions on everything. Once an application goes in, we basically turn around an LOI or a term sheet, depending on what it is, within 48 hours. The board has looked at that. We're not sitting in a room, by the way. It's all web-based. So we've all looked at that. We've given a yay or nay before it even goes forward. So I think the difference is that we have already seen the transaction before you've spent 45 days, 50 days in the underwriting process. All of the decision makers are aware of your deal, and already have expressed some level of comfort. And that's one of the differences that I hear. Let's start with Drew. Drew, what does the process look like? Sorry, I waited until you tried to drink your water.
That's okay, I can wait.
What does the underwriting process look like in the loan approval process?
So once we get a full package, or somewhat of a full package, we actually spend, I think, a little bit more time than other community banks before we provide a term sheet. I think there's nothing worse than when a bank retrades a borrower and switches up a deal. So we actually, what we do is we do something called pre-flight. Some banks call it pre-screen, green light, whatever. But I take all the deal points, we vet it. I run it past basically the decision makers, the chief credit officer, the senior lender, and then we get the term sheet to the borrower. Assuming that we're moving forward, we'll put the loan into underwriting, and the underwriting piece really doesn't take too long. Usually we're ordering an appraisal concurrent to the term sheet acceptance, so have a loan approved in most situations, waiting for the appraisal to come back, which takes 2 to 3 weeks. Sometimes we have to wait for the appraisal to come back. For example, if we're doing a self-storage deal in a market that we're not 100% familiar with, we may want to see that appraisal, feasibility study, whatever, for a little bit more guidance on that sub-market. We do have a loan committee, but it's perfunctory because basically the decision makers have already seen the deal, they've watched it go into underwriting. I haven't actually seen a single loan not be approved in the loan committee. And that process, soup to nuts, takes about a little under 4 weeks, and then we go into doc prep.
Perfect. Jesse?
Yes, so ours, it basically works the same way as Drew's. We pre-screen all the deals prior to putting out a term sheet. So whoever it is that has the ultimate authority to approve it is going to approve our term sheet. But usually we can turn a term sheet out in 3 to 4 days, sometimes overnight, depending on who has to sign on it. Then once we've got a complete credit package, it goes in. It usually takes 2 weeks for underwriting and approval. So typically, from beginning to end, you're about 3 weeks on an full approval and commitment letter. And then closing is typically within 60 days. We can do them within 30 or 45 days, but typically it's a 60-day close.
And I think it's important that you know who's seen the term sheet, because in a lot of finance companies, and not so much on the bank side, but to some level of degree, you could get a term sheet, and I think the general consensus is no one wants to put a term sheet out that they're not going to close. I haven't seen in the industry, not in the good side of the industry, that they're putting out that they have no ambition on closing. We want to close transactions. However, it is important to know who issued it, who looked at it, because you could have a term sheet that's completely worthless and it didn't go through the proper channels. So I think that's something that you should ask, particularly if you're dealing with a bank. You know, who has pen authority, what process is going through. I think that's very important. And I would say, Ken, is your process any different than Drew's, or?
It's not much different at all than Drew's. We do the pre-screen process that takes about 2 weeks. In addition to our 35 offices across the country, we have a 12, 15-person in-house market research team that conducts a market research piece that's attached to each memo. So the highest signatories see that in the pre-screen process. 20 million and below, approval authority is myself and the credit officer. Higher than that, it's the individuals on the committee. So again, more of a perfunctory process and typical closing 30 to 45 days.
Okay, perfect. And Mark, I'd say that you guys have a similar process, but what I would say, if you would just highlight the process as it relates to the agency side and what that approval looks like and why you're different than other agency lenders.
So it's a similar process. The difference with us is we truly rely on the third parties. So, for example, if you have your property condition report and that comes back with certain things, we have to adjust our underwriting in the process. But we go from application to underwriting and credit to commitment with rate lock and closing conditions. Rate lock and close. We've closed deals in 30 days. But as I think everyone in the room knows, it's up to the borrower and how they provide the information and how diligent they are and how, back to what Jason was saying, how concise the information that they've given us up front is. I mean, the day turns into 3, appraisers are backed up. You're gonna have to pay for a rush on appraisal if the information's not correct, and you have to review these documents. But we've closed loans in 30 days, and we've closed them in 120 days, depending on who your borrower is.
Sure. And what's the lead time with the agency? So when you submit a package to an FHA, like right now, how quickly is it that, or not quickly?
Well, FHA, the FHA HUD 221D program is a complete different process. That is, we do a pre-screening up front, and we go to what's called a concept meeting, where the borrower, alongside with us as a lender, has to go to the regional, local office for HUD in the state of Florida. That's in Jacksonville. And you sit with HUD, you go through the project, you go through the sponsor. It's an hour meeting. You have a question and answer, pretty open concept meeting. That's the name of it. It's to discuss the concept of the project. And they typically within 5 business days get back to you with a go forward notice. And then from there you go to application and you go through the process. One thing where we hear the stories, the 24-month stories, the 16-month stories on the FHA HUD process, is when you have borrowers that have gone out and done, they've gone to their architect, they've done plans, they got a great piece of dirt, they've gone to the market, and all of a sudden the debt markets haven't responded to them, or something's moved, and then they want to come to us. That process does not work. That's a 24-month process. You have to be engaged with an architect that has HUD experience. You have to do that process simultaneously, and you got to be willing to commit to the HUD process up front. If you look at the process from acquisition of dirt, to plans, to permit, to site plan approval, to a closing, it's a 9-month process, and your traditional lender is not going to give you a loan or close your loan until you have a permit on a construction loan. So if you time that process accordingly, and if your intent is to go HUD day 1, there's not a big difference in timing, but you got to be willing to do that. Don't come to us after you've gone to the 10 banks and they haven't given you what you want, and your plans and your project does not meet by HUD. Davis-Bacon wages is a big issue with HUD. You have to have your construction numbers. You have to have a GC that's worked and understands reporting on the Davis-Bacon wages. So we can talk more about that offsite here at the conference, but that process could be 2 years if you take that route.
Absolutely. So again, we're making sure that your packages are concise. Some of the bank guys can't get in the data room because of their firewall, but I would ask whoever you're applying with. For us, that's what we do. We send you a link to our data room. We already have all the templates that are out. You drop all your files in. We have a list of where everything goes. We can quickly catch what's missing. When it gets into this whole email, back and forth, things go missing, and you need to make sure that everything's very, very concise, and that if you have to reproduce it, that's not a challenge for you. So, and just keep in mind that we're on we're on the other side of the lending climate and the market, so, things have to be scrutinized a little bit more. We've got about 10 minutes, and I want to make sure that we're asking, answer a few more questions from those. And sir, well, let me get around first, and if not, then I'll certainly circle back to you. On the land side that you asked about, I would say the only person that you can speak to offline is Jesse, unless you guys are doing land, standalone land. I'm out on that one. But if you want to speak with Jesse, he can kind of tell you yay or nay. If it's something he considers, it's going to have to be in South Florida, and there has to be some sort of development or something of that magnitude within the 24-month period. But he's not the land guy. So that we can happen. You can speak to them offline. Can we have another question that's transaction specific or underwriting specific? Sir?
Would you say on the, somebody mentioned you maybe just yourself, you look at pref and mezz pieces. Maybe you talk about how high up in the capital stack, what do you look for specifically with the senior lender? Who you typically maybe work with on the senior side, do you have your own in-house kind of people you pull into the deal? Or do you expect the operator to have everything kind of teed up? That might be a great question for Hunt.
Yeah, that's going to be a great question for Hunt, and I would also say that for those, you want to make sure that if you're going to do something like that on the capital stack, before you really get too much teed up, speak to the bank, speak to the lender, and let them give them an idea of who you're thinking about working with before you spin your wheels and apply, because they may not work with those lenders. There may be covenants that mezz or in those pref agreements that are going to prevent you from working with the senior debt lender. So, just make sure that you let them know, which nowadays folks let us know, hey, we're looking at doing mezz or pref with these folks. It's not going to be an issue, and they can let you know. Mark, what would you say?
So what we've seen from the borrower principal standpoint, also as a lender, the ideal scenario is some of these non-traditional funds that are doing senior and pref blended, and they're trying to get to a target IRR. But you're seeing anywhere let me be clear. I think the FDIC lenders here can appreciate it. They call it pref, right? But it walks and talks and barks like mezz. And I think it wants to be treated more like equity. But when you get into some of these agreements, and to what Jason's saying, when you get into the inter-creditor side of it, where there's assignment of interest, where there's there's triggers as to when the mezz guys can take over, it gets real convoluted and it gets complicated, and now you've gone to two lenders. Some of the funds have taken advantage of this, and they have separate buckets of capital, and they're doing a blended 60, 20, 25. They're getting up to 85. I think the bank lenders would tell you that they don't want you to go over 85, because then that affects their reserve requirements and regulations. So if you're going to go with a traditional bank and then go out in the market and get pref or mezz, they're going to want to limit your limit you under 80, or be around 80 for the most part. But the biggest issue with it, or the biggest thing in the market is, getting your construction lender in place, right? And then going on and shopping for equity, because you got to make sure that you can marry those two guys. And it becomes a third deal, right? You're now going out and trying to close a third deal and marry a pref mezz guy with your senior construction lender.
So, and I think that's where the strength of groups like Hunt, there's not many like that, where you can kind of work directly with those individuals to kind of work through the whole capital stack. I think that makes it a little bit easier, because they know what works and what doesn't work. So if you require that sort of complex capital stack, I would say make sure that your senior lender is someone that could appreciate that. And I would say, just by experience, it's probably going to be, they're going to be finance companies more so than anything.
And just started to, I think what's most important is the question, have you worked with these guys before? Because where the devil really is in the detail, and that's where that goes to your cost. If you have a lender like PNC that's already done business with a pref equity group, they've negotiated documents, they've gone through that, they've had that tussle, or they haven't had a good experience, and so you wanna know that, and you wanna be able to navigate that. But the fact that, just from the standpoint that docs have been done between inter-creditors, which has nothing to do with your docs with both creditors, is a huge value add.
Perfect, and we've got about 5 minutes left. I want to try to squeeze in 2 more questions and answers here, if possible, so let's keep them as concise as possible. Sir?
Yes, you mentioned earlier, regulators need more granular underwriting. Is there any specifics, trends of looking for property types or portfolio management that the regulators are urging?
No, I don't think so. It's just, they're not urging, they just want to make sure that they're complete. They're not asset specific. They want to make sure that each bank's or portfolio is adjusted to where the metrics are sustainable. So I would say no.
I would just add, with respect to the portfolio management side, with the regulatory environment around HPCRE and construction lending primarily. I think there was a question earlier surrounding that. I think there's more scrutiny on the level of construction and development on the bank's balance sheet today than there was 12, 24 months ago. Again, it's not necessarily having an impact of making us change our strategy there, but you're more aware of the level of construction on your book than maybe you were in the past.
Good. One more question, please. Sir?
So just to add to what Mark was saying, we've been working on a 100+ unit multifamily deal, and he has been instrumental in going through the HUD process because it is complex, it's very challenging, but working with somebody like Mark and HUD has been phenomenal. So just wanted to add that.
Your check is in the mail, sir. Good job,
A
Mark.
lot of hand holding and lighting a lot of candles, by the way, late at night, but I have a question, because, and I think what makes this panel great is that we all need each other. I personally, own, I've partnered and have assets of my own and own multifamily, and I wanted to ask this to you guys this morning, when we got together, but I think for me, and I think for a lot of the people in the room, if you can explain what the appraisal review process, because I'm actually going through that right now, and how the regulators, I believe every loan or certain loans under a certain amount have to go through an appraisal review process, from the, I don't know if you can answer that.
Could you give that in 30 seconds?
We use an outside firm where they bid the work, and they have a team of MAIs that internally reviews it. If we take issue with something in the appraisal, and sometimes that happens, we're speaking with competent people. It's a kind of an open forum, but I can't speak specifically to fire and the regulatory aspect of it, but I know that more today than yesterday, that Chinese wall is up. They don't want any of us getting involved on the valuation piece.
Exactly, and I think that's standard practice now. So for us, we haven't ordered appraisals in 4 years. We have a third-party company out on the West Coast. The borrower actually engages them directly, and sends them a link. They order the appraisal, it comes back in, and if they say it's higher or lower, there's a 90% chance we're not gonna be able to overturn it. This is a protective measure for our investors, and I think that's the proper way to go. So thank you. Now, there's a evaluation form. I would encourage you, please, I'm actually asking, if you please would critique us, be kind, please. I wore yellow pants hoping that it would brighten your day a little bit. And so if you do that, and I would also say this to the speakers and these other great panels that are coming up, please do, I know that you guys want to be engaging, but please do as best as you can to make sure that you're engaging the audience. and those that came to pay, and let's try to avoid, not giving what they need, and I'm very thankful for all that have come today. And if you have any questions for us, we'll float around for a little bit specifically, and you guys have a great conference. Thank you.